Sims Q1 webinar. Today our theme is thriving in a low interest market and what investors need to know. Good morning, good afternoon, and good evening wherever you are, and thank you so much for joining today's webinar. My name is Miriam Maku Emisa, and I am going to be moderating the session for today. Awesome. So we are going to go right into it. Today's session is going to be for an hour, so we don't take too much of your time, but we understand how the market is moving, and we're here to engage you and let you know how to stay informed and invested. And today we have our Chief Investment Officer in the person of Nana Riafeboama, who will give us an overview of how the market is performing, especially in this low interest market. And then we have our head of client coverage, who would also be taking us through what we need to do in this market so that we stay invested, informed, and we make the most of our opportunities. We will get started right away because we have just an hour, like I mentioned. If you are not able to join us now, this session will be recorded and put up. The link would also be sent to you so that you can watch it at your leisure time. Thank you very much once again for joining us. And we will start right away by inviting our Chief Investment Officer, Nana Riafeboama. Nana, over to you.
Sure. Thank you very much, Miriam. And thank you for making time to join in today's webinar. So let me start with a simple question. What exactly is an interest rate? At its core, an interest rate is just the price of money. If you are a borrower, it is what you pay. If you are investing, it is what you earn for delayed consumption. Now in Ghana, we've all felt interest rate very directly over the last few years. For instance, we saw interest rate on loans above 30% at some point, and have witnessed a steep decline recently. Equally, we saw treasury bill rates go as high as the mid 30% range at some point. And more recently, we've seen a noticeable decline. But it is important to understand interest rates don't move randomly. Interest rates are the fulcrum around which the entire economy revolves. Here in Ghana, our central bank, which is the Bank of Ghana, uses interest rates as a policy tool to control inflation, to stabilize the cedi, and to support general economic recovery. And beyond policy, interest rate plays a crucial role in financial intermediation. First, they connect savers like yourself to borrowers like business and government. And secondly, they help determine where capital flow within an economy. So when interest rates move, they are not just affecting your return, they are shaping the entire investment environment. Now let's bring this home closer. How does interest rates affect your investment? First, let's look at fixed income investment. And fixed income investment cut across your typical Stanbic Cash Trust, your Stanbic Income Fund Trust, your treasury bill investment, your treasury bond investment, and your bank fixed deposits. When interest rates are high, new investment in fixed income instruments comes with higher yield, making income look attractive. Right? There's a simpler concept called the rule of 72, where if you divide 72 by the interest rate you earn on your investment, it tells you how long it takes to double your money. So as an example, if you are making 24% on your investment, your money doubles about every 3 years. Likewise, if you are making 12%, it takes about 6 years to double your money. So yes, when interest rate falls, income growth slows down. You can only inch closer to your goals by investing more. But that's only one side of the story regarding higher interest rates. When interest rate increases, fixed income investment, especially long-term bond value falls. And this is what we experienced in Ghana recently. I don't intend to remind people of past pain, but the mark-to-market losses that were experienced 2-3 years ago were a result of interest rate increase. Now let's take a look at other asset classes, for instance, equities and fixed income. Yeah, when interest rate comes down, I'm still on the previous slide. Go back there. When interest rate comes down, borrowing becomes cheaper. Businesses can expand more. Investors start looking beyond fixed income. In Ghana, we've seen renewed interest in equities on the Ghana Stock Exchange. We've seen increased activities in real estate and private investment. So lower interest rate is not bad after all. When interest rates are lower, it pushes asset prices up. Stocks becomes attractive. Long-term bonds value goes up. Property values improves. And long-term investment gains momentum. So what fixed income loses in yield, right? Other assets often gain in value and growth. So the big takeaway here is there's no bad environment. Higher rate is great, for income. Lower rate is better and great for capital growth. The key thing to know is how to position your portfolio to benefit throughout, cycles. Now let's put interest rate cycles in perspective. Now let's zoom in a little, bit. Interest rate move in cycles, and this is completely normal. In Ghana, we've gone through a period of high inflation and aggressive, rate hikes or rate increases. Now we are in an environment of interest rate declining as a result of lower inflation, right? And every time this happens, return across various asset class also shift. So for instance, like we said, in the previous slide, when interest rate rises, treasury bills becomes attractive and vice versa. However, bond prices plunges when interest rates are high. Now that we see interest rate declining, bond prices tends to recover, and equities and other assets becomes a little bit more appealing. So what we are experiencing today, even though it is a bit unusual, we haven't seen inflation at 3.4 in a long time. It is part of a typical economic cycle, right? I like to use a simple analogy. Investing is like farming. There are seasons. You don't plant the same crop in every season. You adjust, but you stay invested. And importantly, periods like this often create the best long-term opportunities, even if they feel uncomfortable in the short term. Now let's stay on what truly matters. And in investment, what matters is real return. As an investor, what really matters is not just the return you see, but the purchasing power you keep. This is what we call real return. And real return is simply your return minus inflation. So a simple example is if you earn 20% when inflation is 18%, your real return is 2%, right? So in 2022, your return on your investment was around 23.6. That was the average return on T-bills. However, inflation was 31.5, leaving you with a negative 7.8% real return compared to today's environment where treasury rates are about 6.5. Yet inflation is 3.6. Treasury rate averaging 10.1, inflation 3.6, leaving you with a real return of 6.5. So even though the second return looks very good, right? 23.6% as of 2022. You are actually better off in today's environment where overall real return is higher. So the real question for all of us here is, It's not, am I earning less? The real question is my money growing in real term? So let me leave you with this. Interest rates in Ghana would always rise and fall. This is the nature of every economy, including Ghana. But successful investing is not about chasing the highest return at any point in time. It is about firstly understanding the environment, staying disciplined, and positioning your portfolio for full cycles. Our focus remains simple to ensure that your investment continue to grow, not just in numbers, but in real term over time. And we are here, to help you every step of the way. Desmond will take it over from me.
All right, thank you very much, Nana Riafe. I wrote down a few things. I mean, this has been very enlightening, even though it's been very brief as well. And there were a lot of punchlines, and I took down a few notes. You don't plant the same plant in every season. And what really matters is your real return. And it is quite shocking also to see, I'm sure, for clients that even in low interest markets, your real return is actually higher. And that is what really matters. So thank you very much, Nana Riafe, for setting the tone for us. We are going to transition also now into insights that we can take action from after today. Or once we leave this session, we can implement it for our decision making. And to do that, we have Desmond Bredu, who is the head of clients coverage, to take us through that.
Thank you, Miriam, and thank you, Nana, for setting the scene beautifully. And my job is to bring it home. What are some actionable steps that our clients on the call can take? And allow me to share with you 4 key things to do. And I'll go through them one after the other. But I think the most important reason for this call, just to reorient ourselves. But the first step that you can actually take from here is that you need to have a different orientation towards investment, where you approach it more on like a risk-reward basis. You may know that, or you may have heard the term that the higher the risk, the higher the expected return. So it's really important that we approach it on that side to say that if in these times you're looking at taking or getting more returns, you should be looking at also taking a bit more risk to sort of get the returns you're looking out for. The second thing I'll also journey with you is about how to invest consistently and how the power of compounding can make a big difference, even if in the short term you see some small returns showing on your statement or in your investment. But in the long term, the power of compounding works in your favor. And so I'll show you that also as well. Then I also speak on how to diversify your investment, because it's really important that you don't keep all your eggs in one basket. Having different asset classes to balance the goals and the ambitions and objectives that you have for yourself. Then finally, a key part of investing in low interest environment is to rebalance how you manage your personal finances. Because in simple terms, if income is not really pushing you or investment returns not pushing you that much, what you can actually do is also to increase your contributions. And I'll show you again how to go around that. So allow me to first talk about investing with a risk-reward lens in mind. So the first one is assuming your objective or what you're looking out for is low risk income, and your goal is really about stability and liquidity. You should be looking at some options like investing in a treasury bill or the Stanbic Cash Trust AMC or some other money market funds on the market. Usually, if you're looking at some of these things, your objective is really for about emergency fund. You're looking at how you can have predictable returns over time, and you're looking at really protecting your capital or against sort of inflation. So that is how you think about it. Low risk income. You consider low risk options like the treasury bills, like the fixed deposits, and like your Stanbic Cash Trust AMC. On the screen here, I've shown you a few options in terms of the securities available on the market for the 91-day T-bill, 182-day and 364-day T-bill, and what the returns are. It's also really important to know that the returns that are shown are per annum. And so if you bought a 91-day treasury bill for 4.78%. That is for the whole year. And so for 3 months, you have to divide that 4.78 by 4 to get an actual return of about 1.2 thereabouts. So think about that in that instance. Also, if you can also consider investing in our Stanbic Cash Trust AMC, and the returns that I'm showing you on the screen are actual returns. So yet to date, as of 28th of February, we've made about 1.4% actual return on your money. About 6 months from last year to this year, we've done about 5.7%, and on a 1-year basis, we've done about 14.7% actual return. And so these options give you an opportunity to invest in some low-risk options for you. But please do know that the returns are not a guarantee for future performance. It will definitely vary as our market cycle move on. So assuming that you're not looking for low-risk option, and I already highlighted that you want to take a bit more risk, what are some medium risk income that you can actually look out for? So you can also consider some fixed income funds like Stanbic Income Fund Trust, or like ETFs, REITs, balanced funds, and very soon government will be coming back to issue government bonds. And Nana, I like the fact you mentioned, I don't want to highlight people's pain. When you talk about bonds, people only think of haircut. But again, like I said, if you're looking at taking on more risk, get more return, you should be willing to invest some of these instruments as they come along. But even that notwithstanding, there are still the DDP bonds available for you. And like Nana mentioned, in these times where interest rates are declining or have declined, they also present with you to you some good opportunities to get some increased yields as well. So on the screen as well, I'm showing you what the Stanbic Income Fund Trust has been returning year to date over the past 3 months, over the past 6 months, and the past year as well. And it's interesting to know that over the past year, because of the mark-to-market gains, the Stanbic Income Fund has returned close to 40%. But it's always important to highlight that this return is not guaranteed in the future. But that's what we've actually returned over the past year as well. If you're looking for medium risk income, please be mindful of the duration. Usually you should be thinking of a 3 to 7 year horizon. You don't put money meant for school fees, for instance, in a long-term fund. Maybe school fees is due in 3 months' time. You should be looking at short-term investments as well. Now, I know that for many of us, in this time, what we're looking out for is high returns or high reward. But let me just be quick to say that it means that, and my preamble says that, you need to also be taking on a bit more risk. And so what are some high risk income opportunities that you can actually take in this market? And the first one that we actually see that there's a lot of buzz around is equity, especially on the Ghana stock market. And it's good. It's good that we have a lot of people looking at the equity market, because if we're looking at developing even our market as well, we need a bit more interest also in our equity market, not just on a fixed income as well. This year as well, we've seen our equity market do very strongly. If you see on the screen as well, some listed equities on the market and the returns that they've done year to date. So for example, Republic Bank has done about 310%. Enterprise about 244%, Access about 187%. So this just to tell you that if you're looking for alpha or high risk income, you need to be considering some of these equities as well. But let me be quick to also point out that equity market is not for the weak-hearted. It's for people who can take risk. Let me give you some numbers just to back it up a little bit. So January, the stock market, the entire stock market returned about 2.69%. February, it returned about 46%. And in March, it returned about 54.5% year to date. But guess what? If you look at it on a weekly basis in March, week 1, the year to date was around 62%. Week 2, 78%. Week 3, 79%. But guess what? This week alone, on Tuesday, we saw the 78% decline to 74%. On Wednesday, we saw it decline further to 64%. And just yesterday, we saw it even decline further to 54%. What am I saying? And all I'm saying is that if you're going into something like equity, you need to be mindful of the risk. Same way it is going up, that's the same way it could come down as well. And if you've seen on the market as well, total is returning about -8% on the market. But at the same time, we've heard your feedback. Many of our clients are asking us, When are you bringing an equity fund onto the market? And I'm happy to tell you that very soon, Sims will be launching our equity fund, and you can have options for both the Ghana market and the global market as well. So please be on the lookout for the Sims equity fund that will be coming your way pretty shortly as well. Now, in these times, cherished clients, let me just be quick to point out some common mistakes that people make when it comes to investing in this low interest times. The first one is people are always quick to look for hot investments where they do not do any form of research. All they know is that my friend says, oh, for example, stock A is doing well, let me just go and buy some. Or stock B is doing well, let me just go and buy some, without doing their due diligence. It's really important you do some sort of research before you jump into some of these investments. And like I mentioned, please be mindful of your goals. Don't put short-term money in long-term assets because you are chasing the higher returns, because every investment needs to be matched with your goal that you have for yourself. And also, really importantly in these times, usually Ponzi schemes are on the rise. Usually people will come to you offering you the highest of returns because they know that generally rates have dropped. Please be mindful of joining some of these things. Always ask relevant questions before you jump into these things. And like I said, be mindful. In low interest environment, Ponzi schemes actually are on the rise. So be mindful of some of these things. So that's, in summary, the first part about investing with a risk-reward lens. Let me move to the second part I spoke about in terms of how compounding works in your favor. So let me use an example of somebody who is investing 1,000 cedis every single month for the next 20 years. And I also spoke about the fact that when it comes to investing in low interest times, you need to be increasing your contribution. And so for that purpose, that person will also be increasing their contribution on a yearly basis by 5%. Again, everybody's circumstance is different. For somebody, they can afford to change their standing orders on a yearly basis, either by 5% or by 10%. Let me just briefly pause and ask and just clarify what a standing order is. So for many people, instead of manually having to deposit in their investment every single time, they send an instruction to their bank that, okay, on the 21st, 22nd, take 100 cedis from my account and pay it into this investment account. We highly recommend that because it takes the whole manual process from you and makes a very autonomous process. So that's what we really recommend. So back to my example, 1,000 cedis a month, starting from 2026. What you do is that this 1,000 cedis, you vary it by 5% every single year. Because again, we don't expect so much. But some people can do 10% or 20%. What best ways for you, you do that. What you will see is that over time, that money would grow such that you would realize that time is your biggest asset. Let me demonstrate this for you graphically and in the next slide. So please carefully look at this graph that's currently shown on your screen. The black line represents your contributions you've made over time. Like I said, 1,000 cedis every single month for the next 20 years. But every year, you vary that 1,000 cedis or that contribution by 5%. Over the next 20 years, you could have contributed close to 400,000 cedis in your investment account. Now, guess what? If you look at the graph carefully, just look at the first part from 2026 to 2032. You see there's a very narrow gap between the black line and the blue line. The blue line represents your returns. And the green line represents your total value when you've added your contributions and your returns. Now, guess what? Over the first few years, the gap is very narrow. But as time goes on, the gap begins to widen. And so by the 20th year, you see a huge gap between what your contributions is and what your actual return is. Matter of fact, this figure shows that you are getting close to 1 million cedis, whereas what you contributed is only 400,000 cedis. So more than double what you have actually contributed. So all that we are saying is that, please, in low interest times, one, please be consistent with your investment. Please also look at increasing your value or how much you contribute in your investment over time, because that's what will make a huge value for you. And like I mentioned at the beginning, please don't be concerned in the short term about the narrow spread between your contributions and your return. Over time, that gap will widen. So look at 2046. the green line is way above the black line, and it's only going to get bigger. Think long term, even in this interest rate market as well. So let me conclude by saying that, and now I'll borrow your words. In the words of Kenneth Fisher, and I think you summarized it beautifully, it's not really about you trying to beat the market. It's about the time that you spend in the market, because time plays a huge role when it comes to compounding. It plays a huge role when it comes to how much value you can earn on your money over time. So please start now, be disciplined, even if the amount is small, be consistent, and as your life changes, please adapt to that. So before I conclude, or before I end, please allow me to share with you some important update that has happened in the SIM space, and after that we can take some questions that you may have. For many of you, you may have seen the email from SIMS on the 16th of March from our Managing Director, Kwabena Boama, talking about reopening our Stanbic Cash Trust. So we reopened it 24th of March to give our clients more options. We know some of our clients ask us, what are some options that we can bring on the market? So we've reopened the Stanbic Cash Trust to give you more value. But please know that the Stanbic Cash Trust is still a money market fund that will have exposure to treasury bills. Our Stanbic Cash Trust AMC will still remain a money market fund with no exposure to treasury bills. Now, the Stanbic Cash Trust that we've reopened, we mark to market because of the treasury bill that we've exposed the fund to. And that's nothing new to people who already have investment in there. And so some of the things we can buy in the fund will be treasury bills and fixed deposits. In terms of risk rating, the Stanbic Cash Trust would have a slightly higher risk rating as compared to the Stanbic Cash Trust AMC, even though for both of them, they are low risk options. But in simple terms, for clients who want exposure to treasury bills, please consider the Stanbic Cash Trust that we've recently reopened. For clients who do not want exposure to treasury bills and want the amortized cost valuation, you can still remain in the Stanbic Cash Trust AMC. That is our option that is still available for many of our investors. So in summary, we have the Stanbic Cash Trust AMC for people who are looking for short-term investments, low risk, only exposure to fixed deposits. We have the Stanbic Cash Trust that we've reopened for people who want exposure to treasury bills. We have the Stanbic Income Fund Trust, which are for people who have medium to long-term investments in their mind. And also to know that for the Stanbic Income Fund Trust, every deposit needs to stay invested for a minimum of 2 years if you want to avoid exit fees. So what are some key things to remember? Cash Trust that we've reopened invest in money market instruments, which includes treasury bills and fixed deposits, and is marked to market. The Cash Trust AMC that many of you know will still remain a money market fund and would still invest in short-term investments and will still remain at amortized cost. Then it's also important to know that if you want a fund that has treasury bills, please consider the Cash Trust. And if you don't want the fund that has treasury bills, consider the Cash Trust AMC. And from 24th of March, which was this week, you can start investing in the treasury bill. Just also highlight again, like I mentioned, that we are looking at this year bringing out our equity fund. So please be on the lookout for the equity fund. And once we go live, we'll be more than happy to have you invested in our equity fund as well as a global bond fund as well. So please be on the lookout for it, and we'll be more than happy to engage you on it. So thank you very much, Miriam and Nana, and back to you.
Thank you. Thank you so much, Desmond, and for doing this within time as well. I needed you to give enough time for our clients to also ask questions. I've seen a few people who have put in questions in the chat box that I will be reading out. And for those who can't hear, please unmute the broadcast and then skip to live as well for you to see the live videos. I think what I picked up from you, Desmond, is that even in the low interest rate market, we should stay invested, we should be disciplined and be consistent. And a sure way to go about it is keep our investment automated so that we can keep growing it. And it's amazing to see how the effect of compounding moves our money strongly in the future. So you should not be discouraged in any way that you see markets dropping, interest rate dropping in the market at this point in time. I mean, from Nana's presentation, we saw that real return has actually improved and gotten better as compared to years when we had higher interest rates. So I'm going to go through the chart. So this question, it would go to Desmond. Desmond Isaac Obo says, can you please explain the Stanbic Cash Trust, which is the SCT, further? If you could kindly explain that further.
Okay, so the Stanbic Cash Trust is our money market fund that we recently reopened. That fund is a money market fund. And when we say money market, we mean a fund that invests in short-term securities below 1 year. That fund currently has exposure to fixed deposits and treasury bills. And that fund is marked to market. You can put in money today and come for it at any point in time that you wish to, at no exit fees. For clients who do not want any treasury exposure, the Stanbic Cash Trust AMC is still there for you. And for that as well, you can put in money today and come for it tomorrow at no exit fees. So we have two money market products, one with treasury exposure and one without treasury exposure. It depends on your goals and what you're looking for, and then you can look at which of the options best suits you. Thank you, Miriam.
Okay, thank you very much. I was trying to pick up a question. Okay, that I think it's still in relation to the cash trust, so I'll let you take that for me. The difference in return with the cash trust and the cash trust AMC.
Okay, so in my preamble as well, I said that when it comes to investment, all things being equal, the higher the risk, the higher the expected return. Now, if you look at the screen that I'm showing you as well, the Stanbic Cash Trust has a slightly higher risk as compared to the Stanbic Cash Trust AMC. So all things being equal, the Stanbic Cash Trust should return you better than the Stanbic Cash Trust AMC. But with investment, you can never say everything for certainty. Things would always change, or things do change. But for now, all things being equal, the Stanbic Cash Trust that we recently reopened should have a better return than the Stanbic Cash Trust AMC.
Awesome. So I think we can see that on our screen quickly as well, the differences between the cash trust and then the cash trust AMC. Okay, so one was also asking, Nana, I'll let you respond to this. What does treasury exposures mean? When we say treasury exposures, what does that mean?
Sure. So basically, I mean, the government, I mean, typically is a deficit, I mean, unit within the broader economic framework. Deficit means they raise, I mean, less revenue than they spend, right? I mean, to plug, I mean, that revenue deficit, they borrow, I mean, from you and I, who are mostly seen as a surplus, I mean, unit, right? They can borrow either through treasury bills. Treasury bills have maturities less than 1 year, right? Or they can borrow, I mean, through treasury bond. Treasury bond is when they take your money for a longer, I mean, period of time. So treasury, I mean, basically is government obligations to savers within an economy. So that is a brief explanation, right? Anything less than 1 year is treasury bills, typically 3 maturities, 91, 182, and 364. And then those above, I mean, 2 years are typically treasury, I mean, bonds. Thank you.
Okay. Desmond, as you're going to add on to it, there's also a question about compounding, asking which of our funds is compounding. So please add that to it as well.
So in the context of the earlier question, for the cash trust, the specific one is treasury bills, not treasury bonds. If you want a fund that has bonds in them, please consider the Stanbic Income Fund Trust. the cash trust will not have any bonds, only bills in there, and the income fund is what has the bonds in there. So different profiles as well. So Miriam, on your question, in terms of compounding, all our mutual funds compound, but on a yearly basis. So you do not see the compounding effect on a daily basis. It's more like on a yearly basis. So all our mutual funds actually have the compounding effect. Let me also be quick to add as well. If you look at the graph I showed, a key part of compounding is the consistency. You put money one time and expect it to compound over time. The rate of change will not be as quick as if you be adding on consistently. So in this low interest time, if you want compounding to work in your favor the most, please be consistent in your deposit. It would really make a huge difference in the long term.
Okay. Still on the treasuries and the treasury bill matter, there's a question from Roberta saying, so if I am registered on SIMS, I can buy treasury bill by myself. Oh, the question just moved. Oh. Without going to the bank to request to buy a treasury bill. So she's asking if she can buy directly from us by herself without going to the bank. I think you want to add.
You can't buy directly through SIMS. You have to buy it through the bank. But like I was explaining earlier, the Stanbic Cash Trust has exposure to treasury bill. Let me explain this way. Assuming you went to the bank to buy a T-bill, if you look at the returns I showed you, 91 days around 4%, 182 down 6%. That's the kind of return you'll be looking at getting. You are better off investing in the Stanbic Cash Trust that has T-bills and fixed deposit in there. And as of now, the return is slightly better than if you bought a T-bill on your own. So instead of buying a T-bill in this moment, you are better off either investing in Stanbic Cash Trust or Stanbic Cash Trust AMC. If you want something that will give you even a better return for the long term, consider the Stanbic Income Fund Trust as well.
Okay. Okay. Good morning, everyone. Kofi says, is it possible to have standing orders within the SIMS app for deposits? It will be especially helpful for me as it will make investing on a regular basis easier for me. So I think this question is around, you asked us to automate our investments. So how can clients automate their investments using standing orders or direct debits?
Okay, I mean, thank you. Firstly, thank you for the feedback on how to improve our app. And so we'll definitely look at how to include some of these standing orders in there. But I do know that for the Stanbic app as well, not the SIMS app, the Stanbic app, for Stanbic client, they can set a standing order on the Stanbic app to automate the transfers from their bank account to the investment account. We also have the option of a direct debit. And so if you bank with another bank, you can speak to us, send us an email to simscustomerservice@stanbic.com.gh. We would send you the direct debit forms, and then we'll release your bank to be transferring the money from your account to the SIMS account on a regular basis. But your feedback is well noted. We'll look at how we can improve on that and include that for our clients going forward. But the standing order is really important. Thank you.
Thank you. Nana, I have someone who wants you to spill more beans on what Desmond said about the new fund. So he says, are you going to launch exchange-traded funds or fund that tracks and allows you to invest in companies? That's his question.
I mean, so I think, we'll keep, the, the one who asked the question in suspense, a bit, because we need to go through a lot of regulatory, hurdles to get the fund, approved. But then the commitment, to our client is it would be an interesting and innovative, product we would bring to market, right? We are working very hard to make sure, to make sure, we get that done as soon as possible. Thank you.
All right. Dana wants to keep the beans for a while, so please hold your horse. They would come out very shortly. There was a question I saw earlier about why the deposit button on the Stanbic Income Fund Trust, AMC, was no longer showing. Last year, we had another webinar where we spoke about closing or not receiving deposits anymore into that particular fund because it was a short-term fund, and the cash trust AMC was now available. So those who are in there, funds and monies are still invested on your behalf. However, if you want a short-term investment, the Stanbic Cash Trust AMC is available, and the deposit button would also be available. But there's a question here that I wanted to read out, still on the cash trust and the cash trust AMC. So the question was, is it possible to have both the cash trust and the cash trust AMC accounts?
100%. You can have Stanbic Cash Trust AMC, you can have the Stanbic Cash Trust itself, different objectives. So for example, if I use myself as an example, let's say I'm thinking of paying school fees in, say, 3 months' time. I would invest in Stanbic Cash Trust AMC. Assuming I'm looking at going on vacation in 9 months' time or maybe 12 months' time, I'll look at investing in the Stanbic Cash Trust itself. If I have, say, a 3 to 5 year goal, I would look at investing in the Stanbic Income Fund Trust. So different investments for different purposes. But yes, in simple terms, you can have all of these options. And if you go to the app, you have all of these options to deposit into as well.
Awesome. And if you need any information on it as well, you can check our website for the fact sheet on each fund. You would see the historical performance on all the funds. And also on a monthly basis, we send out our monthly bulletin that gives you the historical performance in terms of rates and how the fund has performed within a month, 3 months, 6 months, a year. And so you have the confidence that this is what the funds are performing. And this is also to address one of the questions about the performance of the funds that we have. I'm going to go to one other question. Jolon Nanariafi, he says, I want to buy a home in 4 years. What fund should I focus on? Stanbic Income Fund Trust? That's the question.
Yes, so I mean, in today's interest rate environment, I mean, the income fund trust is expected, to generate, better returns. However, because the underlying portfolio are in treasury bond, right, you are subject, to price volatilities. The risk is in 4 years' time, if interest rate, goes up, right, and you want your money, to buy the house, there's the probability of capital, loss. However, if interest rate in 4 years' time is where it is, or probably, declines, then you enjoy the benefit of that higher income plus potential capital gain, right? So, in today's interest rate environment, with a 4-year horizon, the Stanbic Income Trust Fund is a better opportunity, than perhaps, the Stanbic Cash Trust, if you are looking, to buy a house. But then just be, mindful of the risk and reward within the Stanbic Income, Trust, Fund. But we can speak. You can speak to, Desmond. You can speak to myself, and then, sit down and then plan, how we can chart, that path to be able to acquire a house, in 4, years. Thank you.
Thank you, Nanariafe. I think it's very important that we sit and plan. Sometimes there are various nuances that need to be added on for us to be able to give you a better advice that fits your context. So please, let's speak further on that. There were a few more questions that I would also throw in. Kingsley Arthur says, who loses or gain between old and new investors, probably depending on the type of investment? I'm not sure if that clarifies.
I think the person is asking in context of the reopen fund.
Good, because his second question is saying, is your reopening of the Stanbic Cash Trust in any way linked to the low inflation? And if it does, would you take it off if the status quo does not remain? I think that's a very good question. Yeah.
So in terms of the first part, nobody loses or gains. Everybody is on the same path, because when we bring in new money, we can rebalance and take advantage of new opportunities as well. But in terms of reopening the fund, and that's why we are quite clear in our minds and for our clients, what the purpose of each fund is, what the risk rating of each fund is. And it's really important that clients are, from the get-go, fully informed about some of these things. So like we showed on the screen, if you're looking for a low-risk option, look at the Stanbic Cash Trust AMC. If you're looking for one that has a slightly higher risk profile, but potentially better return, then you look at the Stanbic Cash Trust. If you're looking at one that has a long-term potential and also potentially bigger returns, then look at the Stanbic Income Fund Trust. So it's not to say that when things change, will change. From the get-go, we are letting our clients know what the underlying is, what the various risk profiles are, and then we can make an informed choice. It's also interesting to know that there's really nothing like a wrong investment. It's about matching your investment with your objective. And so if your objective is short-term, look for a short-term investment. If your objective is long-term, look for a long-term investment so that you can align that appropriately. Thank you very much.
Awesome. Thank you. Nana, do you want to add anything? Oh, that's fine. Okay. So I have a question that I'll quickly address. I think the client was asking, how do you check your SIMS account? Okay. We have various ways you can check it. So we have a web portal, the SIMS online portal, that you can check out. It's SIMS Invest.
Yes.
Invest.sims.com.gh. Invest.sims.com.gh. Then we also have our self-service portal, Sims self-service. You can Google Sims self-service and then you would get the link. And then we have the Sims app also that you can use to check your account. Once you go to the App Store, you can look for Sims Ltd and then download the app so that you can check your account. If you're a Stanbic account holder, great news is that you can still check your account and transact, on your account using the Stanbic mobile app as well. So there are various ways that we have made it possible for you to check your account. So we're going to move on. We have about 12 minutes to the top of the hour. Can you help me understand the major differences between investing with an insurance product from Prudential and SIMS? So please clarify that we don't also have an insurance product.
That's fine. So there are two ways, or there are multiple ways to protect yourself. One way is insurance, and the other way is investing or investment. We don't say either or. It's important to have insurance, and it's very important to have investment. For SIMS, what we have is pure investment. We do know that on the market, there are some insurance companies that offer you an insurance product with an investment underlying. That's also okay. We are saying that have an insurance and also have an investment. It's two different things for two different purposes for that matter. So please still stay with us with your investment, and please consider insurance for yourself as well.
Yes, thank you, Desmond. And our offerings are not insurance, so you can't get that from the company you mentioned, and from us, it's an investment. So talking about investment as well, Abdul wants to know whether it's advantageous to put a lump sum as opposed or compared to monthly debit orders. Nana?
All right, so thank you very much. Good question, right? Good question. And again, let me use a food analogy, right? No matter, the quantity you eat today, right, and you get full, right? Tomorrow, you'll get, hungry, and you need to eat again. So yes, putting in a lump sum, if you have a lump sum, is wonderful, but that should not stop you from regular investment, right? That should not stop you from regular investment. You need your money, working for you throughout every cycle, right? When markets are up and you are investing, you enjoy, the momentum going, up. When market is going down and you are investing, you get a chance to buy, good investment at lower rate, right? So don't stop when you bring in a lump sum, keep investing. And then if you want a program investment, investing, little over the period, don't stop that one too when market takes, a downturn. Learn to invest throughout, cycles, both up cycle and down cycle. Yeah.
Thank you, Nana. Learn to invest throughout the cycles so that you take advantage of every opportunity. So talking about the Stanbic Income Fund Trust and exit fees, one of our clients is asking, what if I deposit in 2026 and I make another deposit in 2027? Does the 2 years minimum wait to avoid exit fees start from 2026 or 2027?
Okay. Good question. So the 2-year exit fees is per deposit. So for instance, 2026, you make a deposit. You can effectively withdraw that money without any charges in 2028. Assuming you deposit again in 2027, you can withdraw that money without any charges in 2029. Our system is configured such that we do first in, first out. So assuming you put in 100 cedis today, you put in 100 cedis next year, and you want to withdraw maybe sometime next year, our system will first withdraw from the very first money that you've deposited. If that one can fully satisfy your withdrawal, there's no exit fees. But if it goes beyond that amount, they need to compute it on the remaining that you're taking from the second deposit. So please be minded that it is per deposit. Every deposit, 2 years to avoid exit fees.
All right. Gideon wants also to know if I deposit into my Stanbic Cash Trust AMC, does it add up to my previous deposit and work as one, or the new deposit works as a separate investment?
So yes, if you check your statement, you see that you have a summation of all the deposits you've done. It goes to add up. But because it's a unit trust, each of them has a different price that you bought it at. So you'll be able to track what each deposit has made for you over a period. But in simple terms, all of them get combined and you get interest on that as well.
Okay. So I think for every update or webinar or engagement we have, there's going to be a mark-to-market question. So we have Boydu or say something asking, please, I want to understand MTM value better. Okay. He wants to understand, so he sees it on his statements, I'm sure. So what is the mark-to-market value? What is MTM? He wants to understand it better. Any one of you can take it.
So MTM is mark-to-market, right? And mark-to-market basically is reflecting your investment value to align with current market price. It's easier to explain with equities. Then I'll dovetail into, fixed income or bonds, right? So today, you buy 100 shares of MTN at 10 cedis, right? Your value is 100 times 10, 1,000. The price for MTN can change in a month's time. So assuming in a month's time, MTN price is 8, your investment value is 800, right? That is mark to market. It's a mark to market loss. Investment value could have gone to, 12, which would have taken your total investment value to 1,002. When it comes to fixed income, interest rate movement influences, the value of your investment. If interest rate goes up, the value of your investment, falls. So you buy a bond for 1,000 cedis at 10% interest rate today. In a year's time, interest rate is no longer 10, it's 12, right? What will you do as a rational investor? You would want to quickly sell your 10% bond and go and chase the the 12% bond, right? By selling your 10% bond, you are going to supply the market with 10% bond. And we did some basic economics, right? The higher the supply, the lower the price. So whilst as a rational investor, you attempt to sell your 10% bond, chasing the 12% bond, the value of that 10% bond would fall simply because interest rate has moved from 10% to 12%. And the vice versa applies for a capital gain. Assuming you bought a bond at 10%, and a years later, interest rate is 8%, right? It means people out there would demand your bond because your bond pays an attractive interest rate. And the more people demand your 10% bond, in today's interest rate environment of 8%, price goes up because the higher the demand, the higher the price. So that is basically what mark-to-market is, right? Mark-to-market applies to every investment, right? Including fixed income, right? If you buy a bond yourself in the market and then you need liquidity and you want to sell, you don't sell at the purchase price or at par. You sell at the prevailing interest rate. And it could be a gain or a loss. If you held bond and you sold last year, you would have received gains. That is mark-to-market gains. So it is a two-edged sword, right? Unfortunately, we remember the losses, but last year was very, very good for bond investors. So that is simply what mark-to-market is.
Thank
I don't know whether Desmond you'd want to break.
No, it's good. It's good understanding. But last year we used the analogy of the tomatoes. Yeah, I think that also brought it home. That you have tomatoes with you. You bought say 10 tomatoes for 10 cedis each, like you said. You go to the market, but people are willing to buy the tomatoes for 8 cedis each because maybe tomatoes is plenty in season. So that's the mark-to-market of that tomatoes. Assuming the same thing, 10 tomatoes, you go now, tomatoes is out of season. You want to sell, everybody will be chasing your tomatoes. And so that you can sell it for 12 cedis. So that's simply what mark-to-market is as well.
Yeah. We've been getting questions like, is the mark-to-market gone? When will the mark-to-market end? So thank you for that explanation. We know that the mark-to-market is a way of valuating the funds or the securities that we have. It's unfortunately connoted to losses because of the time we started implementing it. And so now everyone speaks of mark-to-market as a loss. But like Nana said, last year it was a good year for those who held bonds because the markets changed as well. We have about 2 more minutes to go. I have a number of questions. Hopefully, reps in the chat will also give some responses to it. We want to keep to our time, so I'll take just 2 more questions, and then we will keep the conversation going through our emails, so you can send any question to the Sims customer service inbox, which is simscustomerservice@stanbic.com.gh, and we'll be happy to respond to it to you as well. Okay, the 2 last questions that I would pick up. So a client is asking simply, should I go for cash trust or income fund? Simple question. Should it be cash trust or income fund? Where should I put my money now?
So I'll answer it simply. Why choose when you can do both? Why choose when you can do both? So you can always have the cash trust for your short-term needs. You can also have the income fund for your long-term needs. So assuming a given month you have, say, 2,000 cedis to invest, you can say that, okay, let me put 1,005 in my Stanbic Cash Trust and 500 Ghana cedis in my Stanbic Income Fund Trust. You can always change it based on what you're looking out for, but there's no need to choose when you can have, in fact, all, because now you have Stanbic Cash Trust AMC, and Stanbic Income Fund Trust. Like Nana mentioned, we're bringing out new products for you as well, so keep your eyes peeled. You don't have to choose. You can have as much. Again, because we spoke about diversification. having different asset classes to meet your needs as well. So please don't choose, just invest in both of them at this moment.
Okay. It's 11 o'clock now, so unfortunately we can't answer all the questions live. So I would like to take your final thoughts for today. I'll start with Nana Riafe on our conversations today, what clients have said. What are your final thoughts on that?
Humans, really cannot time, markets, right? So, what I will leave with, the audience is, stay invested, right? Stay invested, be well diversified. Do not put all your eggs in one basket. And compound interest, they say, remains, the eighth wonder of the world. It works miracle. So just keep your hope and faith up and let compound interest, work magic, for you. So thank you, very much.
Thank you, Nana. Desmond, any final thoughts?
Thanks, Miriam. So 2 quick thoughts. The first one is, I want to re-highlight the fact that please take advantage of the standing order that we have, either through the Stanbic app or through the direct debit service that we offer. Please use that to automate your investments, because in this low interest environment, one way of pushing your overall value up is by consistently investing. And we know that doing that through digital means is much more seamless and much more easier than doing that on a manual basis. So that's the first thing I want to share with you. The second bit is that we've reopened the Stanbic Cash Trust. The Stanbic Cash Trust is for people who are looking for a money market fund that has treasury bill exposure. The Stanbic Cash Trust AMC remains a money market fund with no treasury bill exposure. So both funds are open now. They are available for you to invest in. If you're looking for a long-term investment, please consider the Stanbic Income Fund Trust as well. And keep investing even in these low times. And be sure that over time you smile very widely like I'm smiling now.
Thank you all so very much. Thank you for engaging us with your questions, spending time with us today. Thank you for the feedback that you have given to us. It's really valuable. I saw one of the comments from a client saying that this should be done on a quarterly basis. Certainly, we will see you in the next quarter for another engagement. So make sure that you keep invested, you diversify, and you make informed decisions. Thank you once again for spending time with us, and see you at our next client engagement. Have a blessed day. Thank you.